Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today is Thursday, February 21st, and this is part 2 of our discussion on the Brookfield family of companies. I'm your host, Nick Seipel, and today I'm joined by Motley Fool contributor Matt DiLallo via Skype. How you doing, Matt?
Doing great. How are you?
I'm doing great. I'm excited to talk today about 2 more Brookfield Asset Management subsidiaries. That's Brookfield Infrastructure Partners and Brookfield Renewable Partners. First, let's start off talking about Brookfield Infrastructure Partners. This is a company that went public in 2008, came out from the Brookfield Asset Management parent company. And it's one of the largest owners and operators of infrastructure assets in the world, as the name Brookfield Infrastructure Partners might tell you. Matt, what type of infrastructure does Brookfield Infrastructure Partners invest in, and where in the world are they allocating their capital?
Sure. Yeah. So for those who aren't familiar with what infrastructure is, it's kind of the underlying structure of the economy. So it's anything from railroads to pipelines to electricity poles. So it's those things that we tend not to see unless they cause problems. So Brookfield really casts a wide net. They have 4 businesses. One's utilities, and that's, distributing electricity and natural gas to customers. Then they have energy, which it's pipelines, it's natural gas storage, it's district energy, which is in cities where you'll have a couple of buildings connected and they'll have a connected energy system. And then they have transportation, which is ports, rail, and toll roads. And finally, we've got data infrastructure. And that's your cell towers and your data centers. So really a broad range, and they're invested all over the world.
Yeah, and what's great about all these infrastructure assets is that they really put out predictable cash flows. You get, for any of these, you're getting capital based on the amount or the volume of use that your customers are using them. So for a pipeline, for example, the more natural gas or oil that flows through your pipeline, the more you get paid. And for something like natural gas, what we've discussed on this show, you got to get the gas to the market, so you're going to get continual cash flows. It really makes their cash flows really predictable, which is great for a business like this that tends to lean more towards an income a type of strategy. Can you talk about what those steady cash flows really do when it comes to the reliability of the dividend and the way you can really count on that as an investor?
Yeah, because there's long-term contracts, especially in the natural gas pipelines. Brookfield knows what's going to come in. And even in some of the more economically sensitive businesses like a toll road where, they're dependent on volumes of cars passing through, which will decline when there's a recession. There's still a predictability in that. So, they have that predictability of cash flow from those. And then they also have, as you mentioned, the volume growth. As the economy grows, more cars will go on their toll roads, and more oil or natural gas will flow through their pipelines. So then there's that GDP linkage where you'll see the income go up. And so that really gives them the solid base of cash flow that they can pay out in their distribution. And they target about 70% to pay out. And it's a pretty conservative rate that gives them some money to invest in some expansion projects. So it's a really good way to play infrastructure, especially if you're an income focused investor.
Yeah, and they have a really strong track record. So from what I've seen, they hold their average investment for about 8 years, and they generate an internal rate of return above 20% on average, which is really a really strong rate of return. And when you think about the way the business grows, it is predominantly through acquisitions. As we mentioned, their cash flows for the infrastructure that they own are going to be pretty stable over time. So they're going to grow by buying an asset at a reasonable price, holding it for their holding period, and then selling it for more than they bought it for, and then reinvesting that capital, rinse and repeat. Is that a fair characterization of the way the business tends to operate?
Yeah, that's exactly what they're trying to do. And because they're 10 years old, a lot of the assets that they initially had, they've sold them out, and they're entering another period where they're starting to sell assets that they've held for several years. They had a electricity distribution business in Chile that they sold last year for $1.1 billion. And they had held it for years and years and years, but it had gotten to the point where it really maximized all the value out of it. It was only going to grow by about 1% to 2% a year based on the inflation that they were expecting. So it kind of topped out. And so, it was a good time to sell and then to take that cash, and they've ended up, I think they're up to 6 or 7 acquisitions that they have in the pipeline to kind of replace that. So that's their business model is, let's maximize it and then we'll buy something else. It's kind of earlier in the business cycle.
Yeah, Matt, and they've kind of changed their strategy maybe over the past year or so, where in the past they maybe had relied a little bit more on debt to fund their acquisitions, whereas the management has really been open about talking about how they really want to transition from that model more towards self-funding growth, as you mentioned, by kind of recycling their assets through the pipeline. And as we look into the results from 2018, there was kind of a go-forward year when it came to shifting that strategy. Shares were down about 1% over the year, and when you adjust funds from operations to a per unit basis, they were basically flat. So can you talk about how the company is absorbing or adjusting to this change in the way that they fund their acquisitions, and how investors should think about that going forward into 2019?
Yeah, so Brookfield, you mentioned that they use debt and then equity, and part of what they're trying to get away from is issuing equity, because that dilutes investors, and the market just hasn't been as open to new equity issuances from income type entities. MLPs have been hit very, very hard by the energy thing. So, and then a lot of it has to do with rising interest rates. There isn't the investor interest in buying equity. So Brookfield used to be able to issue equity, no problem, to make acquisitions. But because they're so value focused, they look at the value of their equity, and it wasn't appealing to issue it anymore. However, the value of their assets to others, they could sell that for a premium and then reinvest that. So that's kind of how they've decided to shift. Now that hurt them last year, as you mentioned, on a per unit basis. Funds from operation barely budged. However, that was almost entirely due to selling an asset, which they're subsequently reinvesting into several businesses that should grow FFO by about 20% going forward. So it's kind of like they're literally shifting gears. They slow down so that they can reaccelerate with this new business model, and that should make them less susceptible to market crashes like we saw back in December, where if they had a deal that they wanted to fund, it wouldn't have been as attractive if they had to do it as the market selling off.
Yeah, Matt, and let's talk about, as we're talking about the business has transitioned. They're really starting to recycle their assets through, and let's talk about where Brookfield is really seeing opportunities to redeploy its capital and infrastructure. And one of the places they really called out as a significant opportunity for them, you mentioned MLPs and pipelines. That's a place that Brookfield really finds attractive. Back in October, they closed their acquisition of Enbridge's Western Canadian natural gas gathering and processing business. That was a large acquisition that really increased their position in the natural gas pipeline business. Can you talk about that acquisition, and then more broadly, how Brookfield looks at the gas distribution pipeline business as an opportunity for them to grow?
Yeah, so as you kind of hinted at, the energy market downturn in recent years has really made it hard for MLPs and pipeline companies like Enbridge to sell equity to fund growth. So they've turned to selling assets, and Brookfield had an opportunity to buy really one of the best gathering and processing businesses out in Western Canada. And what a gathering process is, if they basically take the natural gas from the wellhead and then they separate the natural gas liquids from the gas, and they make money by fees from the producers pay them fees to do this. So very stable cash flow, lots of growth out there. The shale plays called the Montney. We don't know it much here in the States, but it's a very fast growing shale play out in Canada, lots of natural gas liquids. And so there's a lot of growth opportunity out there as Canada finally starts exporting natural gas in a couple of years when Shell finishes their plant, and then the natural gas liquids they can can use those. They make petrochemicals and other things with those. So it's an opportunity to participate in that growth out there. And then, kind of more broadly, as we mentioned, investors just aren't buying MLPs and pipelines anymore. With interest rates rising, there's other competition like CDs. And then we had, just the market for MLPs had just tank. So there's just that investor fear of, investing in those type of assets. So it's opened the door for Brookfield to start looking and hunting for new deals. And I wouldn't be surprised if they have a couple more this year. It's a huge market opportunity. They've said it's about $150 billion over the next couple of years, just from asset acquisitions and then helping MLPs kind of recapitalize. So lots of opportunities for them out there.
Right. And Brookfield has really positioned their balance sheet to put them in a position to really start deploying capital throughout the next year. So management has mentioned over the past year, they've raised $800 million in debt and preferred equity, as well as refinanced $1.5 billion in debt to put them in a position where they don't have, where management has said, quote, they don't have any maturities to worry about for the next 5 years. They have $3.5 billion in liquidity available right now, in addition to whatever asset sales they may undergo to raise more capital and redeploy that. So as you look forward into the growth opportunities for Brookfield, I mentioned they have a balance sheet that puts them in a position to redeploy their capital. How bullish are you on the growth opportunities for Brookfield Infrastructure Partners looking out over the next few years?
I'm really excited about them. And what's exciting about them, what we kind of haven't talked about yet, is Brookfield doesn't bake acquisitions into their growth forecast. They think they can grow their funds from operations by 6 to 9% per year, and that's all organic. That's volume growing on their through their ports, and it's inflation-linked contracts on their natural gas pipelines. And then there's this third aspect of expansion projects. They have a bunch of expansion projects all around the world. They're working with Kinder Morgan on a natural gas pipeline in the Gulf Coast, and then they've got some projects on their cell towers out in France. So they have a lot of these organic growth projects, and so you have those that should give you that steady growth in the next couple of years, and then you have the added kicker of this value kind of uplift as they sell assets. We mentioned the electricity transmission business that they thought that was only going to grow about 2 to 3% a year. So they sell that and they buy 6 businesses that should grow by a mid-single digit rate. So you're getting a faster organic growth rate from that, plus, the uplift in just the earnings from selling, one business and buying these other ones that they're getting for a better price. So I think it could do, maybe a double-digit total return when you add in the dividend going forward. So it's you're not talking about doubling in the next year or so, but you're talking about if you hold this for several years, you should do very well.
Yeah, you're going to have more cash after holding Brookfield Infrastructure Partners than you did before you bought into the company, and I think that's what you're looking for an investment. And Brookfield really can reliably give you that, and has a track record to prove that. Okay, Matt, let's talk a little bit about Brookfield Renewable Partners. This is another obviously Brookfield subsidiary launched in 2011, and as the name may indicate, they invest in renewable energy assets. Can you talk a little bit about how the Brookfield renewable business is structured and how they make money?
Yeah, so Brookfield's kind of core business is hydropower. That's kind of what their foundation is, and they've gotten into wind, and then more recently they've added some solar through they acquired a stake in Terraform Power and Terraform Global, which are two renewable companies focused on wind and solar. So now they kind of have that full renewable platform. So what's different about Brookfield, though, than like a utility, is that they sell this power to utilities under long-term contracts. So they'll generate steady cash flow as the electricity is generated out of their hydropower. They're getting paid a steady rate, and that insulates them from power prices, which can fluctuate based on demand. So you've got that steady cash flow coming in, and that's what I think makes them an interesting way to play renewables.
Sure. And you mentioned they're mostly hydropower. I think about 3/4 of their assets, of Brookfield Renewables assets, are allocated towards hydroelectric power. They really like the opportunity there because it has a really long useful life. Once you get the dam in place to generate power, the capital costs to maintain it are relatively low. And another thing that they mentioned, which I find interesting, and it ties into some discussions we've had previously on the show, is that they're able to match power supply with demand. So you talk about solar and wind. There can be some issues with demand for power not lining up to maybe when the sun is shining or the wind's blowing. But when it comes to hydropower, you can really regulate that because you can just stop water flowing through the dam to line things up with demand. So they really have focused in hydro for a long period of time. But over the past few years, as you mentioned, they've started moving more into wind and solar. And management has said the reason they stayed away from wind and solar for the longest time was because the economics didn't make sense, or there wasn't a clear path to profitability to acquiring these assets. However, in the past few years, as prices for these systems have started to come down, they've really started to push into those assets. And I think that's another case of indicating just the way Brookfield thinks about investing in assets. It's not that, hey, the demand for this is going to go over time. It's how can I make a cash return on this investment? And I want to talk, we talked about how this Terraform investment has really moved them into solar energy in a meaningful way where they maybe hadn't been before. And this Terraform acquisition really lines up with those other acquisitions we talked about in part one last week. They bought the Terraform Power out of bankruptcy from SunEdison. Can you talk about how that transaction shook out and what advantages that gave to Brookfield being able to buy a distressed asset like Terraform?
Yeah, it lines up with Brookfield asset management's kind of overarching goals to buy for value. They'll target something and they'll kind of keep an eye out until they see something of value. But it also needs to be substantial enough to provide them a platform. So they saw an opportunity when SunEdison went bankrupt to kind of take over their yieldcos. And so they pounced on that opportunity and they took Terraform Global private, and they have a sizable stake in Terraform Power. And that gives them that platform in wind and solar that they can expand. And they've been able to help Terraform Power expand significantly since they took it over. They bought a stake, or they bought a Spanish wind and solar company last year, and so that expanded them into Western Europe, and that's kind of their goal going forward, is to be able to expand this business.
Yeah, I saw from that acquisition, they doubled the annualized cash flows for Terraform Power. It really helped them with capital structure. They were able to help them get out of some unfavorable financing covenants and really put them in a position to generate stable cash flows over time. It's just another example of how when Brookfield buys these assets, they really know how to position them well, not just for the value that they have when they acquire them, but what steps can we take after we acquire this asset to really increase its value even further. Another thing they're moving into, another thing I found interesting, is they're moving into energy storage. When you talk about renewable energy, I mentioned lining up the supply of energy with demand. Energy storage really helps with that when you're looking at wind and solar. Do you think that is a significant opportunity for Brookfield, or is that just more peripheral to the other assets they own? How should we think about the energy storage part of their investments?
I do think that it's going to be important for renewable growth overall, to be able to have storage that's cheap enough to make it economically viable. And one of the companies that's really kind of on the forefront of that is NextEra Energy, and they actually just signed a deal with the utility to do wind, solar, and storage at the same location.
Yeah, Matt, another thing that I really found interesting about what Brookfield Renewable is doing is they're expanding their investments into energy storage. We've talked about on this show in the past, and it relates to what I said earlier on the hydroelectric assets, when it comes to the ability to line up renewable energy supply with demand for energy production assets like wind and solar that only produce power when the sun's when the sun is out or the wind is blowing. Do you see the energy storage opportunity as one of significance for Brookfield Renewable, and how should investors think about that when they think about this investment?
Yeah, I do think it's a significant step for them because, as you mentioned, the intermittency of renewables has been kind of a drag on growth for that, and it's been something that those that are against it have kind of pointed out that we need this baseline power. So it does take companies to invest in these and to add them now, and so it's good to see them making these investments. And I do think we're going to see a lot more of that going forward, not only from Brookfield but from others in the industry. NextEra Energy is one that has kind of been at the forefront of energy storage, and they recently signed an interesting deal with a utility out in the West Coast where they're building a huge energy facility that'll include wind, solar, and storage. So, if the sun's not shining, it'd probably be windy. And if it's not windy and the sun's not shining, they'll have that energy storage component. And, so I think that's going to be something that we'll see a lot more of, where they're going to add in this energy storage. And NextEra Energy CEO was kind of clear that the way the cost curve has kind of come and the way technology has improved, that within a decade, and I'm probably, I'm paraphrasing his quote because I don't have it offhand, but within a decade, when you add in energy storage to wind and solar, and this is without government incentives, it should be lower than all forms of power other than natural gas on a high efficiency system. So that was a bold statement, but it's definitely the direction that the industry is heading in. And, that's really exciting, with climate change worries and just getting rid of emissions in general, to see that happening. So it's exciting.
Yeah, and for a company like Brookfield, it shows that there's opportunities to make profit on these investments today, which is why we're seeing them start to move into the space, particularly with wind and solar. Let's talk a little bit about Brookfield Renewable's yield. I think that's one of the most attractive parts about this business. It yields almost 7%, and when you talk about the energy assets they have, their cash flows are really predictable because, particularly with the renewable energy, the sun is going to keep coming out, the wind's going to keep blowing, and the rivers are going to keep flowing to power these hydro assets. So when you look at this dividend, how attractive is it to you as an investor, and what prospects might we have for it to continue to increase over time?
Yeah, I'm a very much of an income-focused investor, and it's because companies that increase their dividends, put it that way, the data has shown that they tend to outperform all other companies. So anytime I see a company that pays an attractive dividend, that they have clear visibility to increase it, that's going to catch my eye. And then, you add in the renewables, and, it just makes this such an attractive long-term holding for really any investor that, you're going to need income eventually. So whether, you're quite a ways away from retirement like I am, it's still, I can reinvest that into other opportunities. But, so you're looking at an investment that's going to pay very steady cash flow. It's going to increase. They just raised it 5% for this coming year, and they have clear visibility to continue to raise it because they can sign up higher price contracts for the power as, contracts expire. And then they're developing new wind and hydro projects and solar around the world, and then acquisition. So you have kind of 3 or 4 growth drivers of this company that's going to take that dividend up and up and up.
Yeah, and if you look out over time, I think throughout its history as a business, it's delivered an annual total return that's taking into account the dividend of 15% over time, which really, if you can give me a 15% compounded annual return, that really over time is going to compound your wealth in a significant way. Let's talk a little bit about Brookfield Renewables' balance sheet. We got another question from listener Noel Sayers about that, saying he's really been staying away from Brookfield Renewable, both because he sees them as having a heavy debt load on their balance sheet, as well as we mentioned on the part one of this Brookfield discussion that you can listen to last week, that he's concerned about the fees that Brookfield Asset Management charges to the Brookfield Renewable subsidiary. So we already covered the question about the management fees. You can go back and listen to our episode last week if you want to hear about that. But when you look at Brookfield Renewable's balance sheet, do you have concerns over the level of debt that they are carrying today?
I don't, because Brookfield structures its debt to investment grade ratings, and they also do it typically on the asset level or on the business level. They own several operating businesses. We mentioned TerraForm Power. They own a big stake in that. So you factor in TerraForm's debt, and then they own a business out in Ireland, and they own one out in, I believe it's Colombia. And so the debt's at those levels, at those business levels, those asset levels. So it's non-recourse to Brookfield, which means if one of those businesses goes bankrupt, they would restructure that business, and it wouldn't have any impact on Brookfield. So, you have that debt down at those levels. It's all investment grade, how they structure it. So in this case, Brookfield looks for 3 times EBITDA, which is, for a business that's generating very stable cash flow, to have a debt level that's pretty low. So I'm not really worried about them. I actually like the fact that they have an investment grade balance sheet. And for me, that's a stamp of approval to say that, somebody that's a lot smarter than me on credit believes that this is a solid, from a credit standpoint. And what an investment grade balance sheet really means is that when a downturn comes, this is a company that should still be able to pay its bills. And so that's something that I'm very comfortable with.
Yeah, as well, it allows Brookfield to raise debt at lower interest rates. And when you talk about the ability that they have to allocate their capital in a way to drive attractive returns, if you can, say, raise debt at 3 or 4% and then reinvest that capital at 7 or 8%, that's a really good position to be in as an asset allocating business. When we think about where Brookfield Renewable is going to be going forward, there are opportunities to continue expanding over time. What opportunities do you see there for the business, and how excited are you about the opportunities in renewable, both for the Brookfield, but then in general across the broader market? It
was the third quarter shareholder letter that Brookfield put out, and I highly recommend reading any of Brookfield's shareholder letters, because there's always some nugget in there that just kind of mind-blowing. And this one in particular, the CEO of Brookfield Renewable said that it's a $10 trillion opportunity in renewables to basically wean the global economy off of fossil fuels. And that's only in the markets that Brookfield operates in, which are big markets, the United States, Canada, those, big developed countries. But that just shows you the size of the opportunity for them to invest capital. And with them investing it on a value basis, there's just going to be really good opportunities for them, because they'll wait for situations like a Terraform where they can scoop it up for, really good valuations. So I'm very excited about what they can do. They think they can invest probably $700 million a year just in acquisitions, and that'll grow over time as their cash flow grows. So it's one of the most exciting, for me, renewables out there.
Yeah, because when you look at renewables, the way they're positioned to grow over time, as I've continued to mention, the ability of Brookfield's executives to allocate capital in a very prudent way that's going to generate returns over time. It's really an attractive way to get exposure to renewables in a space that sometimes can be difficult to find opportunities that both give you a strong risk adjusted return. When you look at maybe solar panel makers over time, they've really been tough companies to own for investors. Brookfield gives you a way to get exposure to those really important trends in a way that you can really sleep at night, which I find really attractive as an investor. What do you think, Matt?
Oh, absolutely. Yeah, I've been burned, to use a pun, on solar panel makers several times. So this is one of the few times that I've actually made money on renewables. So I'm excited for that to continue.
Yeah, Matt. And before we go away, over these last 2 episodes, we've discussed Brookfield Asset Management, Brookfield Property Partners, Business Partners, Infrastructure, the entire family of Brookfield companies. As you look out at this potential basket of investments, are there any of them that particularly stand out to you? As if I only had a certain amount of capital to invest, this would be the one that I would invest in. How do you think about choosing between this entire family of businesses to invest in?
Well, I think if I was an investor just starting out, and I would go with Brookfield Asset Management for 2 reasons. One, you get the whole, the whole pie. You get the renewables, you get the infrastructure, you get the property, and then you also don't have to deal with those Schedule K-1s that we mentioned in last week's episode. So it's a much easier investment for somebody to make in a retirement account, for example. So that's where I would start. And, but if somebody wanted to, wanted specifically exposure to renewables or property, then I would look more at the subsidiaries, especially if you were more income focused. But if you're younger and looking for a retirement option, Brookfield Asset Management would be the top one I'd buy.
Awesome, Matt. I would probably agree with you there. Just the simplicity from a tax point of view, the exposure across all the family of businesses, I find really attractive. I will say Brookfield Renewable is something that does appear very attractive to me. I like the way they've allocated assets. You just mentioned how big the total market opportunity is. But I think you really can't go wrong with anybody in these family of companies. It really check a lot of the boxes that you're looking for as an investor. So definitely a company that I think our listeners should pay attention to, both the parent as well as all the subsidiaries. Matt, I want to thank you for coming on these past couple episodes. I really, really hope we shared some valuable information for our listeners.
Thanks for having me.
Awesome, Matt. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against stocks mentioned, so don't buy or sell anything based solely on what you hear. Thanks to Rick Engdahl and Dan Boyd for their work behind the glass. For Matt DeLallo, I'm Nick Seiple. Thanks for listening, and Fool on.